Hello everyone, hope you guys have a great day. My name is Nur Nadira Ashikin binti Muhammad Puatiu, and usually people call me Nadira. But before we proceed with the questions, I would like to introduce to you all my teammates.
Hello, my name is Siti Nabila binti Abdul Wahid and you can call me Nabila.
Hi, my name is Nurul Shazwani binti Mak Faizal and you can call me Wani.
Hi, my name is Shaza Aida binti Wamanasi. You can call me Shaza.
Hello, my name is Siti Marini binti Ahmad Bakri. You can call me Marini.
Hi, my name is Hamiza binti Sahmuddin. You can call me Miza.
Hello, my name is Siti Khadijah binti Muhta. You can call me Khadijah.
Hi, my name is Nurul Afika binti Muhammad Yunus. You can call me Afika.
Now we proceed to the first question under budgeting and budgetary control topics.
I will proceed with the question 4A. The question is to determine the unit variable cost and also fixed cost of the above cost by using high-low method. For the first one, direct material, we need to find the UVC. To find the UVC, 72,000, we minus with 24,000 and we divide by 6,000 minus with 2,000 and we will get RM 12 ringgit. For the next one, direct wages. The UVC 42,000 minus with 14,000 and we divide by 6,000 minus with 2,000 and we will get RM 7 ringgit. For the administrative salaries, the UVC 38,000 minus with 16,000 and we divide by 6,000 minus with 2,000 and we will get RM 5 ringgit and 50 cents. For the other overheads, the UVC 86,500 we minus with 30,500 and we divide by 6,000 minus with 2,000 and we will get RM 14 ringgit. For the rental and depreciation, there is no UVC because it remains constant. For the fixed cost, there is no fixed cost for the direct material and also direct wages because it is naturally variable cost. So we need to find the total fixed cost for the administrative salaries and also other overheads. The equation is the unit variable cost we minus with actual unit produced and we plus with fixed cost. So for the total fixed cost administrative salaries, RM 5 ringgit 50 cents we times with 5,300 unit and we plus with 5,000 ringgit and we will get 34,150 ringgit. For the other overheads, the total fixed cost RM 14 ringgit we times with 5,300 and we plus with 2,500 ringgit and we will get 76,700 ringgit.
Okay, next we proceed with the next question, which is prepare cost performance report for April 2019 by showing clearly the variables that rise. For the actual cost column, we take the value directly from the question. For the flexible budget, direct materials, we need to multiply 12 ringgit with 5,300 units, where we will get 63,600. For direct wages, we need to multiply 7 ringgit with 5,300 units, where we will get 37,100. For the administrative salaries, we need to multiply 5 ringgit and 50 cents with 5,300 units and add it up with 5,000 ringgit, where we will get 34,150. For the other overheads, we need to multiply 14 ringgit with 5,300 units and add it up with 2,500 ringgit, where we will get 76,700. For rental, we get 13,000 and for depreciation expenses, we get 8,500. Next, to determine the variance, we must know that it is favorable when the actual cost is less than budget cost and adverse when the actual cost is more than budget cost. So, for the variance, we have to find the difference between the actual cost and the flexible budget. In direct materials, we get the variance of 10,400, which is adverse. For the direct wages, we get to the variance of 200 and it is favorable. For the administrative salaries, we get the variance of 4,450 and it is adverse. For the other overhead, we get the variance of 800 which is favorable. For rental, we get the variance of 400 which is adverse, and for the depreciation expenses, we get the variance of 200 which is adverse.
For question 4C, briefly explain two differences between fixed and flexible budget. A fixed budget is the kind of budget where the income and the expenditure are determined. Irrespective of any fluctuation or changes, this budget will remain static. Companies that are static execute the same sort of transactions can greatly benefit from a fixed budget. But wherever there are fluctuations, a fixed budget does not turn out to be the most suited one. A flexible budget, on the other hand, is a budget that is flexible as per the needs of the hour. For example, if the company sees that it can sell off more of its products by expending more in advertisement costs, a flexible budget will help execute that. That's why a flexible budget is very effective for companies who go through a lot of changes during a particular period.
That's all for question number 1. Now we proceed to the second question and the standard costing and variance analysis topic.
For the question 2A, we have to prepare a standard cost card for a special container per unit. And we also have to show clearly the standard profit and standard selling price per unit. Okay, let's start the sub-question by tabulating the standard cost card for 1 unit special container. Okay, first of all, the direct material, the information is given in the question. The standard quantity is 10 kilogram and the standard price is 5 ringgit. We have to multiply both standard quantity with the standard price and we get 50 ringgit. Okay, the information to calculate the direct labor, the variable overhead and also fixed overhead is given indirectly in the question. So we have to calculate it manually. We have to multiply both standard hours with the standard rate and we get 35 ringgit and 1 cent. For the variable overhead, the standard hours is also 3 hours. So we have to multiply both the standard hours multiplied by variable overhead absorption rate and we get 9 ringgit. And for the fixed overhead, the standard quantity is 1 unit. So the fixed overhead we get 6 ringgit. We sum up all of the result, hence we get the standard cost, which is 100 ringgit and 1 cent. Since the standard selling price is not given, we have to calculate it by sales revenue, which is 600,000 divided by sales volume, which is 4,000 unit, and we get 150 ringgit. So now we can easily calculate the standard profit, which is standard selling price minus by standard cost, and we get 50 ringgit and 1 cent.
For the question 5B, we are required to calculate the following variance. The first one is direct material price variance. The formula is standard price minus actual price times actual quantity purchased. So 5 ringgit minus 5 ringgit 10 cents times 49,020 units. So we have 4,902, which is negative value, so it is adverse. For the second question is direct material usage variance. The formula is standard quantity minus actual product minus actual quantity usage times standard price. So 10 units times 4,200 units minus 49,020 units times 5 ringgit. So we get 35,100. It is negative value, so it is adverse. The third one is direct labor rate. The formula is standard rate minus actual rate times actual hour pay. So 11 ringgit and 67 cent minus 35 ringgit and 48 cents times 3.5 hours. So we get 83.34. It is also negative value, so it is also adverse.
So for the next question is direct labor efficiency variance. So for the formula is standard hour multiplied with actual product minus actual hour work times with standard rate. So 3 hours times with 4,200 unit minus 14,700 hour times 11.67 ringgit. So we will get 24,500, which is negative variance. So it is adverse. So for the next question is variable overhead expenditure. So the formula is actual hour times with variable overhead absorption rate minus actual variable overhead. So 14,700 hour times with 3 minus 36,750, we will get 7,350. So it is positive variance. So it is favorable. So for the next question is to calculate variable overhead efficiency. So the formula is standard hour multiplied with actual product minus actual hour multiplied with variable overhead absorption rate. So 3 hour we multiply with 4,200 unit minus 14,700 hours times with 3. So we will get 6,300. So it is negative variance, so it is adverse.
For question 5b7, we have to calculate the fixed overhead expenditure variance. The formula is budgeted fixed overhead cost minus actual fixed overhead cost. So 24,000 ringgit minus 33,075 ringgit. So the answer is 9,075, which is a negative variance, so it is adverse. For question 5b8, we have to calculate the fixed overhead volume variance. The formula is budgeted production volume minus actual production volume times fixed overhead absorption rate per unit. So 4,000 units minus 4,200 units times 24,000 ringgit divided by 4,000 units, and we will get 200 units times 6 ringgit per unit. So the answer is 12,000, which is a negative variance, so it is favorable. For question 5b9, we have to calculate the sales price variance. The formula is standard sales price minus actual sales price times actual sales volume. To calculate the standard sales price, the formula is budgeted sales revenue divided by budgeted sales volume, while for actual sales price, the formula is actual sales revenue divided by actual sales volume. So 600,000 ringgit divided by 4,000 units minus 504,000 ringgit divided by 4,200 units times with 4,200 units, and we will get 150 ringgit minus 120 ringgit times 4,200 units. So the answer is 126,000, which is a positive variance, so it is adverse. For question 5b10, we have to calculate the sales volume variance. The formula is standard sales volume minus actual sales volume times standard sales price, and we will get 4,000 units minus 4,200 units times with 150 ringgit. So the answer is 30,000, which is a negative variance, so it is favorable.
The question is give 2 reasons for adverse material price variance. So the first reason for adverse material price variance was purchase of material of higher quality than the standard, which means when we purchase a material with the higher quality than usual, so there will be the adverse material price variance occur. Second is loss of purchase discount due to smaller order size. When we order in a small quantity or small order size, we might be lost the discount that offered by the supplier. Last but not least, briefly explain the difference between standard cost and budget. So the first difference is the term standard is actually a unit concept, while the budget cost is referred to total concept. It may be helpful to think as standard as a budget for a production of a single unit of output. So the second difference is Review and revision of a budget cost is more frequently based on the changing of the circumstance than those standard costs. Standard costs are more static and subject to less changes. So that's all from us.